Welcome to the Value Investment Partners Yearly Review. Here, we'll take a look at the impact of events throughout the year, our economy, as well as the performance and movements of your portfolio. By far the most significant event of the 2016 financial year was the exit of the United Kingdom from the European Union on the 23rd of June, an event otherwise known as Brexit. The result came as a shock victory for the Leave campaigners, who were paying a 4-to-1 chance of winning by major bookkeepers. As the world was largely expecting the Great Britain population to vote for a stay decision, this made for a dark day in all global markets, with $50 billion wiped off the Australian Stock Exchange. Despite VIP's belief that Britain was more than likely to stay, we had organised a contingency plan to cater for both possibilities, and as a result found ourselves with the opportunity to increase our holdings into the market at severely discounted prices. In terms of our own economy, Australia's market has been fairly robust considering we are well past our peak in the mineral capital spending cycle. Strong growth in consumer spending, housing construction and exports have helped offset the downturn in mining investment. The economy grew at 3.1% this year, the highest annual growth reading for 3.5 years, and a figure that was largely aided by a low Australian dollar, which stimulates our economy. Notably, the RBA continues to attempt to push the AUD further down through rate cuts, with the RBA cash rate reduced from 2% to 1.75% in May. Australia's seasonally adjusted unemployment rate unexpectedly fell to 5.7% in March 2016 from 5.8% in February, this being the lowest jobless rate since September 2013. Given it was a turbulent time in the global markets in financial year 2016, VIP has proven resilient throughout this period. The Australian equities portfolio recorded a 5.98% return, exceeding the index's negative 0.35%. This return was achieved while taking on more risk, with a standard deviation of 17%, which exceeds the index's 14.9%. We now take a look at the portfolio adjustments that have occurred over the financial year. As of the 1st of July 2015, the portfolio held 15 securities, which can be seen here. Throughout July, the VIP Investment Committee decided to sell Wesfarmers, believing it to be trading above fair value, and Rio Tinto due to iron ore's weakness as a byproduct of a slowing China. In replacement, Harvey Norman was acquired to benefit from forecasted sales increases as a result of the government's budget announcements for small businesses. In August, currency fluctuations coupled with uncertainty in Russia and Brazil led Ansell to issue forecasts slower than expected range, and the stock was subsequently sold. September brought Harvey Norman to what we believed to be full price, and it was therefore sold. To replace its weighting, BHP was bought as it boasted a good yield and was acquired at the bottom of the commodity cycle. Furthermore, Spark Infrastructure was bought to boost infrastructure holdings. In October, Origin Energy was sold after consecutive months of poor performance. Boral was acquired to capitalise on the construction boom of Australia, and the Bank of Queensland to increase the portfolio's bank exposure. While there was no change in November, December saw a Brazilian mining disaster in a BHP mine, and consequently its stock price suffered, although VIP was able to sell before it hit its bottom. CIMIC was bought to replace this weighting, again demonstrating VIP's favourability to construction at this stage. The first changes in the new year came in February, when Macquarie Bank and TPG Telecom were acquired, both for their growth prospects. The next changes came in April. In terms of stocks sold, Macquarie Bank was released to reduce VIP's exposure to banks, and CIMIC was sold at what we believe to be fair value. Lendlease, while it had been a stronghold in the VIP portfolios for consecutive years, has had its run and was therefore sold. In its place, Flight Centre was acquired in order to gain an exposure to a powerful travel brand that underpins a consistently successful growth culture. Furthermore, Sydney Airport was acquired for its strong cash flow and their notable efforts to improve management and admin. Finally, in June, Flight Centre was sold after failure to meet expectations. With 10 stocks sold over the financial year, the portfolio had a 66% turnover. This concludes our 2016 yearly review.